You did an article recently, Brendon, how tariffs could shake up BC real estate. And you talked about this being economic self-sabotage. How are these tariffs going to impact Canada, and what are the risks specifically to BC?
Yeah, so we wrote a whole a research piece on this called "Choose Your Own Misadventure." That I think the Real Estate Magazine or Real Estate Weekly, whichever publication it was, picked up, and it sort of goes through, because there's a number of different scenarios from whatever the magnitude of the tariff ends up being. We had done scenarios of 10%, because that was the original proposal kind of back in November of last year, and then we did some 25% proposals. And then also, it really depends on what the inflationary impact is. If we retaliate, so if Canada puts a matching tariff on U.S. imports, as we said we would do on 50% of U.S. imports, it really depends on what that does to inflation and how long that inflation stays around. Because it really has implications for what the Bank of Canada might be able to do in response. So, we can kind of remember from pretty recent history, the Bank of Canada thinking that inflation during the pandemic was transitory, and it hung around a lot longer than anyone thought it was going to. You could see something similar with tariffs, where you get prices spiking, starts to get built into expectations of households and businesses, and just lasts a lot longer than anyone initially expected. And the Bank of Canada, therefore, couldn't lower rates, may even have to raise rates to fight that inflation. So there's a number of different scenarios. I think the most likely is a kind of a one-time shock to inflation if we responded with tariffs of our own, and the Bank of Canada could respond pretty aggressively, but there's enough risk that they would go the other way.
So we have a BC housing shortage here. How will these tariffs complicate affordability in your view?
So the initial shock is all on the demand side, of course, right? So if the BC economy falls into a recession, as is certainly possible with a 25% across the board tariff, demand is going to fall. Prices will probably come down a bit. Rates will also come down. So the overall affordability equation probably comes out on the side of a little bit. Well, it depends on what the income impacts are, but maybe a slight improvement in affordability over time, just because rates would be lower, prices are a bit lower. After the initial kind of shock, though, the impact on new construction starts to kind of feed into the overall amount of inventory in the market. So if suddenly projects aren't viable because market conditions are really poor, and we're having, as we're kind of seeing right now, a bit of a backlog of new completed units that aren't selling, that kind of inventory starts to pile up, and that means that new projects can't go ahead. And kind of 5 years down the road, we're at a shortage again, because we just weren't able to get enough projects into the pipeline.
So if we do see an economic slowdown here, do you see, further to your point, that they're going to drop interest rates further? Could that potentially create a buying frenzy and drive up prices? Do you see that as a possibility?
Yeah, one of our scenarios is one where with transitory inflation, so an initial spike in inflation, and the Bank of Canada, with a bit of a delay, is able to cut pretty sharply. I think in our model, they cut their overnight rate to like 1% or something, maybe a bit lower. That causes 5-year fixed rates to fall to under 3%, and we get a really strong recovery in the housing market. Pretty similar to what we've seen in every recession in BC in the past. The typical pattern in BC is that home sales have an initial decline, 6 to 9 months, and then in the year following a recession, home sales are up on average about 30%. There's only 4 recessions to kind of look at, but we usually get very strong recoveries because interest rates are much lower. I would expect we have a very similar situation to that. What that does to prices, it really depends on what the inventory situation is. We're at a level of pretty decent inventory right now. January new listings across the province were really high. Probably going to start the year with one of the kind of healthiest amounts of active listings we've seen in probably close to a decade. So we're at a point where we have a fair amount of supply in the market right now. But But again, like if we had kind of an adverse shock, maybe we had an even bigger increase in supply. One of the sort of nightmare scenarios in my head is this sort of goes on for a little while, like into 2026. And you have an economy that's really weak at the same time that the bulk of fixed rate borrowers are getting hit by repayments and renewals on their mortgages. That could cause some inventory to really kind of flood the market, just in terms of thinking about risks. Not our baseline, but like you know, as far as things that would kind of keep me up at night, that would be the one that would be pretty worrying.
So you're one of the main economists that I follow, Brendon, but I also follow a guy, Benjamin Tal, and I listen to what this guy has to say. And he argues that we're actually in a per capita recession. He's saying that GDP is down 20% over the last 5 quarters in a row. He's arguing that basically the economy has been bolstered by the 1.2 million new people coming to Canada over the last couple of years. Can you break that down? What is a per capita recession? Why aren't we technically in a recession?
So we don't tend to use per capita GDP as a business cycle indicator. It's more of a living standard kind of comparison. But in Canada, we've had very strong population growth, especially the past couple of years, and pretty weak GDP growth. So the amount of stuff or income we're producing per person in Canada has been extraordinarily weak, and it's been falling for a few quarters. I don't like to focus on it too much because that's going to get fixed maybe in the next quarter, we'll have positive per capita GDP growth, but we haven't without actually fixing any of the underlying problems. Like the problem in Canada long term is that we just don't have strong enough productivity growth. The problem in the short term is that we've had population growth that's just far too rapid, like 3% population growth in an economy like Canada just doesn't really work. The government right now is trying to engineer pretty massive outflows of non-permanent residents. So over the past couple of years, they kind of took their eye off the ball on the number of people that were coming in as international students and temporary foreign workers, to the point where we had about 1 million non-permanent residents come into Canada, I think, over a 2-year period. The share of the population that's non-permanent was like 8%. They want to get that back down to 5%. To do that, they're planning to engineer an outflow of about 900,000 people over the next 2 years. So we're going to have, if they can do that, we're actually going to have negative population growth for the first time since Confederation in 1867. That doesn't like fix anything, right? That just means, all right, well, we're kind of reset our GDP per capita a bit, but it doesn't fix why our economy is growing. Look, it doesn't fix the numerator; it just addresses the denominator. What we need longer term is real reforms to fix really lackluster productivity growth in Canada, so that, you know, at normal amounts of population growth, we can still produce higher living standards.
Yeah, I feel like the Liberal government really dropped the ball here. Okay, another point Benjamin Tal makes is that he talks about the Toronto market, and he says there was a sharp drop in sales. Toronto market's pretty beat up. I've got some agents that I talked to in Toronto, but we've also seen a corresponding drop in new condo construction. And what he's arguing is that a year or two from now, further to your point earlier, we're going to have a big hole in the market because there's going to be no supply. And I noticed that in Vancouver. Like when I look at the downtown skyline, I see some purpose-built rentals, I see some leasehold projects, but I don't see a lot in the way of actual stratified condos in the pipeline. And I'm wondering if there's going to be a big hole in the market going out a year or two.
Yeah, so the past couple of years, because demand conditions have been pretty weak and borrowing costs are really high, the only thing that we saw getting built was purpose-built rental, because there were so many incentive programs from the federal government to build purpose-built rental, which, you know, is a part of the market we ignored for a few decades prior to recent enthusiasm for it. So that does mean like probably not as many ownership condo projects that can get underway, and maybe that leads to a bit of a shortage. Right now, I think, though, if you look at the number of units completed and unsold in Vancouver, it's at its highest level in about a decade. So there are, on the ownership side, there are a lot of projects that are having difficulty, selling the units that were held back from pre-sale because they completed into a market that's been pretty weak over the last 2 years. That alone is enough, I think, to kind of slow down some projects. We're seeing that in Vancouver, we're seeing it in Victoria, we're seeing it in Kelowna, where just normally you just don't we don't pay a ton of attention to new inventory because it usually sells very quickly and it hasn't really been a problem for such a long time. But it's certainly something I'm keeping an eye on now, and it's one of those things along with other problems developers have had over the past couple of years. And a lot of it, some of it's rising borrowing costs, but a lot of it's just delays and permitting, just adding to costs, and projects can't get finished. All those things have the potential to 5 years from now, put us back in the situation we don't want to be in, where we're short of supply again. What we really want is just like consistent supply, and it's not something we've ever been able to engineer, at least as far as as long as I've been in the industry.
Yeah, no, it just goes in these waves, these cycles, right? Okay, the mortgage renewal cliff. You actually talked earlier about that, your nightmare scenario. Yeah. But again, going back to Tal, he's saying that, and you might argue these numbers, I'm not too sure. He says that 40% of renewals in 2025 will actually renew at a lower rate. And he says that 60% of those renewals will probably be negligible. What's your take on that?
Yeah, no, I'd have to read his piece on it. I guess if you're renewing at a lower rate, that would be a variable that you took out at a really higher. I don't know. That doesn't really make a lot of sense. Like if you're renewing in 2025 at where 5-year fixed rates are now, which is like 4.7, that's a lot higher than rates were in 5 years ago in 2021. So it doesn't make a ton of sense to me. A lot of, if you look at the Bank of Canada's modeling, they have the average increase in mortgage payment for a 5-year fixed borrower. I think it's about 25% increase, which is a pretty significant jump. We weathered the first couple of years of this storm really well, though, without any hit to like financial vulnerability. Consumer bankruptcies were at record lows, still are. Mortgage defaults are up very, very slightly from like 0.1% to 0.17 in BC. So and that was with people with variable rate mortgages or variable rate, with variable payments or variable rate with fixed payments, getting reset at like 30-40% higher payments. And we managed that pretty well without any real disruptions. Obviously more borrowers are on fixed rates. So we might be a larger share that are getting a reset at 20-25% higher payments for the next couple of years, which is fine as long as it's not happening in an economy that's in really rough shape. Like the worst kind of combination is when the unemployment rate's rising and you have a really weak housing market. That's the worst type of scenario for potential mortgage defaults, which again, not like the baseline, but we could see at least like a real uptick in listings activity if people can't afford their homes. I'm not saying they're going to get foreclosed on or default or something, but we could see a real uptick in listings at least, and some real motivated sellers. Just something to watch. Like it's not like that's our forecast for the next 2 years is for kind of fire sale supply hitting the market. It's just like if you're thinking about risks over the next couple of years. And obviously this is compounded by the tariff situation, because otherwise the economy would be in fine shape and we wouldn't really have to worry about it.
So given all this, I mean, there's so many variables at play, right? But what would your overall outlook for BC real estate be? If you're a first-time buyer, would you advise just like wait on the sidelines until we get more clarity? Or would you be trying to get approved, get the ball rolling, get your financing in place? What would be your take on it?
Yeah, my take is always don't try and time the market. So if you're, it's really, these things are obviously extraordinarily hard to predict. There is a ton of uncertainty right now, but if you've got like a 5-year time horizon, hopefully we're not talking about tariffs 5 years from now, and we'll be kind of past the worst of that. So I'm always a proponent of if you found something that you can afford and that you're comfortable with staying in for a 5-year period or something where you can kind of you don't have to worry about the ups and downs of the housing cycle. History has shown it's probably better to get in than to wait.
Yeah. I always say the whole red sky at night, sailor's delight, where everything's going to be calm on the horizon. It never really happens. I mean, the last time we had this conversation, probably a year or two ago, and it was very uncertain then as well. So there's always going to be these headwinds, right?
Always. Yeah. There's always something to worry about, right? There's always some reason why now might not be the best time. But it's history, especially a market like Vancouver, has been shockingly resilient. So it's sort of the market I worry about the least. My worries with Vancouver are always on the affordability side, not on any kind of potential for things to kind of unwind.
Mm-hmm. Mm-hmm. Okay. Well, thanks, Brendon. We'll leave it at that. I appreciate you taking the time, man.
Anytime.